This is Thoughts on Investing. Today, we're shifting gears and talking about dividends, how they work, why investors use them, and how they actually help build long-term income. Let's start with the basics. What exactly are dividends? Dividends are just cash payments that companies choose to give back to shareholders. When a company earns a profit and doesn't need all that money to grow the business, it can share some of it with its owners, the shareholders, through dividends. Dividends have been around for as long as public companies have existed. In the early days of stock markets, companies paid dividends regularly because investors bought stocks mainly for the income they produced. It was a simple trade. You supplied capital, the company ran the business, and you got a share of the profits. Over time, this evolved into the modern dividend system many investors know today. Now, some people wonder how common dividend payers are in the stock market, especially among large, well-known companies. If we look at the S&P 500, which tracks roughly 500 of the largest U.S. companies, there are well over 400 companies that pay dividends. That means around 80% or more of the index companies return cash to shareholders through dividends. Another interesting point is the dividend yield. That's the percentage of a company's share price that gets paid out each year as dividends. For the S&P 500 as a whole, the dividend yield today is around 1.1 to 1.2%. That might sound low compared with bond yields or past decades, but it shows dividends are still a material part of investors' returns. Over the long run, dividends have been an important part of total market returns. Historically, reinvested dividends have contributed a very significant portion of total return in the S&P 500, especially when you consider compound growth over decades. So in short, dividends are cash payouts from profits. They started because early investors expected income from their stock ownership, and most large U.S. companies pay dividends, making them a big part of how people invest for income and long-term returns. Now that we understand what dividends are, the next thing to clear up is this. Not all dividend stocks are the same. When people talk about dividend investing, they often mean very different things without realizing it. So let's break the main types down in a simple way. First, there are high-yield dividend stocks. These are companies that pay a large dividend relative to their share price. They're attractive because the income looks good right away. You often find these in sectors like utilities, telecom, energy, or real estate. The trade-off is risk. High yields can sometimes be a warning sign. If a company's business weakens, the dividend may get cut and the stock price can fall. So high yield doesn't automatically mean high quality. The second group is dividend growth stocks. These companies may not pay a huge dividend today, but they increase their dividend year after year. This is important because rising dividends usually mean rising earnings and strong cash flow. Over time, dividend growth can be very powerful. Your income grows, and the stock price often follows. Many long-term investors prefer this type because it balances income and growth. Then you have dividend aristocrats and dividend kings. These are companies that have raised their dividends consistently for decades. To earn that reputation, a company has to survive recessions, market crashes, and major economic changes, while still increasing payouts. That kind of consistency usually signals a very strong and stable business. The yield might not always be high, but reliability is the main appeal. Another category is income-focused sectors, like REITs and certain financials. These businesses are structured to return a large portion of their cash flow to investors. They can be excellent income generators, but they're often sensitive to interest rates and economic cycles. So timing and diversification matter here. Finally, there are hybrid dividend stocks. These are companies that pay a dividend, but also invest heavily in growth. You don't get massive income upfront, but you get a mix of cash returns and long-term upside. This type often appeals to investors who don't want to choose between income and growth. So when people say, "I invest in dividend stocks," the real question is, are they looking for income now? Income that grows over time? Maximum stability? Or a balance of everything? Understanding these differences matters, because the right dividend strategy depends on your goals, not just the yield number you see on a screen. Now that we understand the different types of dividend stocks, let's talk about the debate around them. Because dividend investing has both strong supporters and strong critics. Let's start with the bear case. The biggest criticism is that dividend stocks can limit growth. When a company pays dividends, that's cash it's not reinvesting into expanding the business. So critics argue that younger or faster-growing calm. Another concern is dividend cuts. Dividends are not guaranteed. If a company's earnings drop, the dividend can be reduced or suspended, and when that happens, the stock price often falls at the same time. This is especially true for companies with very high yields, where the payout may not be sustainable. There's also the argument that dividend stocks can underperform during strong bull markets. When growth stocks are flying, dividend stocks often look boring. They move slower, and investors chasing returns may ignore them. So the bear case sounds like this. Dividend stocks can be slower, less exciting, and still carry risk if the business weakens. Now let's talk about the bull case, because this is where dividend investing really shows its strength. The biggest advantage of dividend stocks is reliable cash flow. You're not relying only on the stock price going up. You're getting paid just for holding the stock. That income can be reinvested, saved, or used to cover expenses, and over time, that flexibility matters. Another key point is discipline. Companies that pay dividends are often more careful with capital. They tend to focus on stable earnings and strong cash flow because they know shareholders expect consistent payouts. That discipline can reduce risk. Dividend stocks also tend to perform well during volatile or uncertain markets. When prices move sideways or markets struggle, dividends provide a real return while you wait. Over long periods, dividends and dividend reinvestment have made up a significant portion of total market returns. And then there's the psychological side. Receiving regular income makes it easier to stay invested during downturns. Instead of panicking during drawdowns, investors see cash coming in, which helps reduce emotional decision-making. So when you put it all together, the bull case isn't about chasing the highest yield. It's about building a durable strategy that works across different market environments. Dividend stocks may not always outperform in raging bull markets, but they tend to hold up better when growth slows, volatility rises, or markets move sideways. And that balance is exactly why dividend investing continues to attract long-term investors. Now let's get practical. How do you actually choose good dividend stocks? And just as important, how do you avoid the traps? Because not every dividend is a good dividend. The first thing I look at is cash flow. Dividends are paid from cash, not from accounting profits. If a company consistently generates strong free cash flow, it's much more likely to sustain and grow its dividend. If cash flow is weak or unstable, the dividend is at risk. The second thing is the payout ratio. This simply tells you how much of the company's earnings are being paid out as dividends. If a company is paying out almost all of its earnings, there's very little room for error. A reasonable payout ratio gives the company flexibility during downturns. Next, I look at dividend history. Has the company paid dividends consistently? Has it increased them over time? A long history of stable or growing dividends usually signals a resilient business that can survive different market conditions. Another important factor is the business itself. Good dividend stocks usually come from companies with predictable revenue, things people keep buying regardless of the economy. That doesn't mean no risk, but it does mean less volatility. Now let's talk about common traps, because this is where many investors get hurt. The biggest trap is chasing high yield. A very high dividend yield often means the stock price has fallen sharply. Sometimes that fall is justified. If the business is weakening, the dividend may look attractive right before it gets cut. High yield without strong cash flow is a red flag. Another trap is ignoring debt. Some companies borrow money to maintain dividends. That can work. There's also the trap of concentration. Putting too much money into one stock or one sector for income increases risk. Even strong dividend companies can face unexpected problems. Diversification matters, even for income strategies. And finally, there's the false sense of safety. Dividend stocks are not risk-free. They can still decline in price, especially during market stress. The dividend helps, but it doesn't eliminate risk. So the goal isn't to find the highest yield. The goal is to find companies with strong cash flow, reasonable payouts, durable businesses, and a history of rewarding shareholders responsibly. That's how dividend investing works best over the long term. So let's wrap this up with some realistic expectations. Dividend investing is powerful, but it's not magic. If you have a small account and you're expecting high returns quickly from dividend stocks, that's usually a mistake. Dividends work through time and consistency, not speed. Building meaningful income from dividends takes years, not months. Now, if you already have a larger portfolio, dividends can be very effective. They can generate regular income, monthly or quarterly, depending on the stocks you own. And at the same time, your money stays invested in real businesses, which helps protect you from inflation over the long term. That's an important point. With dividends, you're not just chasing income. You're owning shares in companies with strong fundamentals, reliable cash flow, and long-term relevance. But the key is mindset. Dividend stocks should not be treated like short-term trades. They're not designed to deliver quick wins or predictable monthly gains in stock price. The real value comes from steady investing and patience, especially if you earn an average salary or you're still building wealth. The best approach is usually simple. Invest a small, consistent portion of your income, maybe every 2 weeks or once a month. This helps avoid trying to time the market, chasing peaks, or stressing about bottoms. Over time, that consistency smooths out price swings and builds positions in quality companies. The focus should be on building a solid portfolio of businesses that show strong and improving financial numbers, have durable fundamentals, and return cash to shareholders through dividends done this way. Dividend investing becomes less about short-term results and more about creating long-term stability and income. And that's where dividends really shine. If this video helped you better understand dividends, don't forget to like the video and subscribe to the channel. It really helps support the content. Thanks for watching. And just a quick disclaimer, nothing in this video is financial advice. I'm sharing my personal views for educational purposes only. Investing involves risk, and past performance doesn't guarantee future results. Always do your own research and consider your own situation before investing.